Thank you very much for the kind invitation to be here. It's a real honor to follow Dr. Pachauri. His presentation and his summary of the IPCC synthesis report has made it abundantly clear that what we need to do in the financial world is move at scale and at speed towards a low-carbon economy. And the question is, what can we do from the financial community to help achieve these goals? I'm going to give you some perspectives of a large global financial institution, and I'm going to draw from some of the insights we've had in our own commitment, which is to try and mobilize $70 billion over the next 10 years towards that low-carbon economy. We've seen what works, we've seen what hasn't worked, and hopefully there's some lessons there for all of us. The fundamental issue in terms of why we're not seeing more finance flowing towards the low-carbon economy is that the financing challenge needs to be tailored for each of the different types of investors. We need to reflect the fact that the investment community is heterogeneous. You've got different investors who have different risk and return expectations. And so the key is to try and achieve the right balance for each of those different segments to make sure they can come on board and increase their exposure in low-carbon areas. The barriers that people talk about from different investors are risk impediments, policy impediments, cost impediments, and sometimes liquidity. That is to say, the size of the investment opportunities are simply too small for them to be interested in. The issue of, is there enough capital, I think is focusing on the wrong issue. There is more than enough capital. If you look at the institutional investor community alone, $86 trillion of assets under management, including a nice chunk here in Norway, I must say, with the Sovereign Wealth Fund. The question is, how can we deploy some of that money in ways to help shift the needle? And so I'm going to turn briefly to what policymakers can do to try and shift this risk and return balance, because this is very pressing as we go towards the Paris negotiations next year. And to break it down in simple terms, there are really three things we can do as policymakers. Number one is try to improve the outcome of the return in terms of an equity investment or a debt investment by shifting the balance of that risk return. The second is reduce the risk of the financing cycle, in the financing cycle for different types of investors. So to give you an example of the first increase the return type option, you could see a price of carbon. That would shift the risk return in sufficient ways to incentivize more investment in low carbon. Removal of fossil fuel subsidies would also help to shift the balance. In terms of reducing risk, examples include greater use by multilateral development institutions, overseas development organizations, of their risk mitigation toolkit. Why not use your balance sheet as a government or as a multilateral development bank with a AAA rating to try to deploy some capital as a partial risk guarantee? That would be an example of a way where the risks would be diminished, you might close the viability gap, and you'd have more investors feeling comfortable about going down a low-carbon investment opportunity. The third example is also really important in terms of the political dynamic. Because when we talk about low carbon, we often think scale, large renewables in the energy sector, transformation in transport, infrastructure to allow more hybrid and electric vehicles, this kind of thing. But let's not forget that there's also something called the base of the pyramid, something like 4 billion people surviving on less than $10 a day. And from a political perspective, it's important to engage with that segment as well. And I know Norway has been a leader with its Energy Plus initiative. So some of the most interesting deals that I've been involved with have actually included substitution of kerosene for solar in the lighting sector in sub-Saharan Africa, or shifting away from charcoal as a cooking fuel to alternatives like bioethanol. We mustn't forget about that segment, and in terms of financially, what can we do? Oftentimes, it's about providing capital up front, because many of these solutions actually pay for themselves. The next part, which I won't go into in depth, is simply to say that there are many specific risks that investors talk about when thinking in low-carbon opportunities in the emerging markets. In a sense, it becomes risk squared, because you have a whole variety of additional risks to do with the country, to do with concerns about policy, investment frameworks that also need to be addressed. I will also say that in many cases, the biggest concern that deters investors is retroactive change of policy. And the area where we've seen that in the most significant terms is, ironically, in Europe. So, in closing, let me just give you a flavor of the positive, the solutions. And I'm going to draw here from our work at Bank of America Merrill Lynch in co-chairing something called Sustainable Energy for All Finance. And this is a UN initiative, but it involves many individuals from the private sector, from the public sector, from the NGO community. And we've basically boiled down the financing question into 4 major themes that we think have huge potential to grow the finance going into this space. Number 1 is green bonds. And I'm happy to say that in this area, green bonds, we've seen a 4 times growth year on year. That's a tremendous sign of what's possible, and there's no reason why the green bond market can't continue on that trajectory over the next 10 years. The second is structures that do better job at risk sharing between the public sector and the private sector. And again, very happy to see that at the finance session of the UN Secretary-General Summit just a few weeks ago, the multilateral development banks came with a commitment to do precisely this. So again, we're seeing very positive progress. The third area is more innovative uses of insurance. It would be great if the insurance market could help de-risk some of these opportunities for private investors. And then the fourth is aggregation. And one of the big successes, again, in the last 12 months has been the development of new products that successfully bundle together opportunities, particularly in the renewable space, to allow investors to go after that sector. And I won't get into the details, but yieldcos are one example of how we've achieved that. So we think we have significant potential to do a massive scale-up of finance if we can do better collaboration amongst the different types of capital in the financial community, better job of capacity building, specifically when it comes to the emerging markets, so that the quality of the projects become investable. And then the third is more innovative use of public funds to try to catalyze more private capital to flow at scale. In closing, let me just say, because someone asked me at the lunch, what's the relevance of the financial sector for the climate negotiations in Paris? And I think the best image to think about is the Eiffel Tower. The Eiffel Tower has 4 legs. One of the legs, from a financial perspective, is we need to get more finance flowing into the low-carbon economy. We need to see less finance flowing into the high-carbon economy. We need to see better disclosure of financial risks, particularly from climate change. And then the fourth and final one is we need a financial regulatory system that is aligned with all of this and that is greener and reflects the full array of climate risks and opportunities. Thank you very much for your attention.